Welcome. You're with us for this exploration, and today we're getting into something really fundamental for deal making, share classes.
That's right. We're using Magnus Kjøller's book, Deal Structuring, as our guide here.
Yeah, it's a great resource. So share classes, basically different categories of a company's stock.
Exactly. Think of them as different types of ownership slices, but crucially, they don't all come with the same perks or rights.
Okay, and understanding that difference is key, right? Especially if you're investing or maybe even setting up your own company.
Absolutely critical. For investors, you need to know what you're actually buying. What kind of say do you get? What happens if things go south?
And for the company side.
Well, for founders and companies, it's about how you bring in money, how you keep control, how you maybe reward your team. It's foundational stuff.
Right. The chapter in Kaler's book really sort of lays it all out. It's not just about owning a piece, but what kind of piece.
Precisely. What does that ownership actually mean in practice? Influence, returns, protection. It all ties back to the share class.
Okay, so let's unpack the main differences. The book points out a few key areas. Voting rights seems like a big one to start with.
Definitely. Voting rights are, well, fundamental to control. You might think it's always one share, one vote, but it's often not that simple.
Oh, how so?
Well, you can have structures where certain shares, maybe those held by the founders, get, say, 10 votes per share. Super voting rights.
Ah, so they can keep control even if they don't own, like, 51% of the company?
Exactly. It lets them raise capital without giving up the steering wheel, essentially.
And the flip side, can shares have fewer votes or none?
Yep, that happens too. Some classes might have limited voting rights or sometimes none at all, often issued to employees or certain types of investors.
Okay. So as an investor, you could find a great deal valuation-wise.
Right.
But if the shares have no votes?
You've got to ask yourself, how much influence do you really want? Are you okay being a passenger, or do you need some control over the direction the share class tells you that?
That makes sense. It's a trade-off you need to be aware of.
A very common one.
All right, another difference the book mentions is dividend rights.
Mm.
So how profits get shared out, that's not always equal either.
Not at all. Preferred shares, which the book discusses more later regarding risk, often get priority.
Priority how? Like they get paid first.
Yeah, exactly. If the company decides to pay dividends, the preferred shareholders often get their agreed-upon amount before any common shareholders see a dime.
Okay, so it's like a queue. Preferred's at the front.
Pretty much. It can be a way to offer investors a bit more certainty or at least preference on the income side.
And I imagine that can get complex too.
Oh, yeah. You can have cumulative dividends where missed payments stack up and have to be paid out later.
Yeah.
Lots of variations. Shows the flexibility you have when designing these things.
Right. Now, what about when things don't go well, like a company sale or liquidation? This is where preferred shares really show their value, isn't it?
Absolutely. This is where liquidation preferences come in. It's a huge concept in venture deals, and Keeler covers it well. It's about protecting that initial investment.
So how does that work in practice?
Well, imagine an investor puts in, say, $100,000 for preferred shares. If the company later sells, that investor might have the right to get their $100,000 back first before the common shareholders get anything.
The book has a good example. Like if the company sells for $2 million.
Right. With a simple preference, the investor gets their $100 pay back, then the remaining $1.9 million goes to the common holders.
Okay. But what if the sale is much lower, say only $250,000?
That's where it really bites for the common shareholders. The preferred investor still gets their $100K first. That only leaves $150K for everyone else.
Wow, okay. So without that preference, the investor would have taken a much bigger hit on that $250K sale.
A significantly bigger hit. It's major downside protection.
The book also mentions participating and capped preferences briefly. Can you touch on those?
Sure, participating means after they get their initial money back, they also get a share of the rest, alongside the common shareholders. Kind of a double dip.
Okay. And capped.
Capped means there's a limit. They get their money back first, maybe participate up to a certain total return, like 2x or 3x their investment, but then that's it. The rest goes to common. It balances protection with upside potential for others.
Got it. And there's dilution protection too, right?
Yeah.
Especially for preferred shares.
Yes, that's another key right often attached to preferred stock. When the company issues new shares later on, maybe in another funding round.
It waters down everyone's ownership percentage. Dilution.
Exactly. Anti-dilution clauses adjust the preferred shareholder's stake, maybe by changing the price at which their shares convert to common stock to counteract that dilution effect. at least partially.
Okay, so we've covered quite a few differences: voting, dividends, liquidation, dilution. It's clear there are pros and cons depending on which side you're on. Let's look at that. For an investor, what are the main upsides of, say, preferred shares?
Well, the big one is that liquidation preference we talked about. Downside protection. Then there's the potential for dividend priority. And sometimes specific voting rights or vetoes over major decisions. Plus, the anti-dilution protection helps maintain their stake.
Sounds pretty good. What about the downsides for investors? Or maybe the risks for common shareholders in a structure like that?
Well, for common shareholders, they're lower down the pecking order in a liquidation, so more risk there. And if preferred holders have strong voting rights, common holders might have very little actual say, especially if they're minority owners.
Right. Now, flipping it around, for the company trying to raise money, what are the benefits of offering these different share classes?
Flexibility is key. It lets you appeal to different types of investors. Some might want the safety of preferred rights. Others might be okay with common stock if the potential upside is huge.
So you can tailor the offering.
Pretty much. And critically, it allows founders to raise significant capital without necessarily losing control by issuing shares with fewer or no voting rights. That's a huge driver for dual-class structures.
That makes a lot of sense for founders wanting to execute a specific vision. And how does this relate to employee stock options? The book mentions a vesting pool.
Typically, employee options convert into common shares. So you're giving employees skin in the game, aligning them with the company's success.
But without giving them the preferential rights or maybe the voting power that external investors might demand.
Exactly. It's a way to incentivize talent without complicating the core control structure too much, at least initially.
Are there downsides for the company, though, having this complex structure?
Oh, definitely. It can become harder to manage, harder for new investors to understand later on. You can also create potential conflicts between the interests of different shareholder groups.
Like preferred versus common.
Yeah. And a really complex or founder-biased structure might make future funding rounds or even an exit, like an IPO or acquisition, more difficult if it's not structured thoughtfully from the beginning.
Okay. To sort of bring this all together, maybe some quick general examples. How would these typically look in a startup scenario?
Sure. So you'll usually have the founders holding common stock, maybe with super voting rights initially. Then employees get options that vest into standard common stock.
And the investors? VCs, angels.
They often come in with preferred stock. They're putting in cash, so they negotiate for those protections. The liquidation preference is almost standard, maybe preferred dividends, some control rights like board seats or vetoes, and anti-dilution clauses.
So that structure balances the founder's need for control, the employee's need for incentive, and the investor's need for protection and potential return.
That's the goal, yes. It's a negotiation, of course, but that's a very common setup you'll see described conceptually in resources like Kjøller's book.
It really drives home why understanding share classes isn't just, academic.
Yeah.
It's absolutely core to structuring any investment deal.
It completely shapes the risk, the reward, the control, everything. It's what gets negotiated in those term sheets and investment agreements. It's fundamental.
Okay, so let's recap. Share classes, they're distinct categories of stock, not just different names. They carry different rights, affecting votes, dividends, and liquidation outcomes.
And understanding these differences is, well, non-negotiable for serious investors and for companies looking to raise capital effectively. It dictates who gets what, when, and how much say they have.
This knowledge really gives you a solid base for understanding company ownership and navigating investment deals.
Absolutely. And the way Deal Structuring by Magnus Kjøller breaks it down is incredibly clear and practical. It's a fantastic foundation.
Totally agree. If you want to get deeper into this, we definitely recommend checking out Deal Structuring. It's getting great reviews, really gaining traction for its straightforward approach. You can find it easily on Amazon.
We'll pop a link below too. And don't forget to check out dealstructuring.com. Lots more tools and resources there for anyone involved in, well, structuring deals.
Definitely worth a look. So as a final thought to leave you with, think about how deliberately designing these share classes isn't just about attracting money, but how it fundamentally shapes how a company is governed and, ultimately, its chances for long-term success. Thanks for joining us.